For this chapter, I'm using the model from your book. So the first one that we have is an expansion project, and we have some outflows in year 0 that are given and explained in the book, but the two that are given are the building and equipment of $900 and then additional net working capital of $100, and these are both negative because they're money going out. You'll see down below that you'll have some positive, the positive cash flow of 100 to recover the net working capital at the end of the project. So that's an out and in money. The next thing you have are the unit sales. So these are given to you as what they're projecting they're going to sell. And then the sales price in this case is set at $2. So the variable costs are set at various numbers as given in row 9. And then we get to actually starting to work the spreadsheet here. So we have sales revenue, which is equal to $2 up here, times the unit sales. So this 5370 is calculated based on those two numbers. And the variable costs are calculated likewise. We have 2,685 units and the variable cost of 1.018. So that's done consistently across those two lines. And then given in the problem also is that the fixed operating cost except for depreciation is 2,000, so that number simply comes in from below. And then the depreciation is calculated using a maker's system. So we have the $900 down here, and the maker system is right here, 33% the first year, 45, 15, and 7, and so the amounts of the depreciation are right here. It also shows you what the straight line would have been, which would have been 25% per year or $225 each time. So that's where the depreciation number is coming, and that gives you your total operating cost here of 5032, and that's calculated as the variable cost plus the fixed cost plus the depreciation. And then we get to our operating income, which is our revenue, 5370, less those total operating costs of 5032 to get 338. And that gives you your tax to the point where you can figure your taxes. Your taxes are given at 40%. So 40% times whatever your EBT is. And so on this year, the first year, it's 135. And so we end up with our after-tax operating income, which is after subtracting off the tax amount. And then we add back depreciation. So this number is going to be exactly the same number as it is up here on line 12. I'm sorry, line 13, 297. And the reason that's added back in is because it's a non-cash expenditure. We do not write a check for depreciation. We count it both places. It's counted up here because without counting it up here, you cannot correctly calculate your taxes. But then we add it back in here. So then that gives us our cash flow. So we have the cash flow for all 4 years. The next thing that we have to do is we have to calculate any kinds of additional cash flow that's going to happen, particularly at the end of the project. And so we have salvage value. In this case, it's given as 50. And then the taxes on that. So this was given as someone would purchase our $900 worth of building and equipment for $50. You're taxed on those at 40%, so you're taxed on them at $20. So your after-tax cash flow on that is a positive 30. And then again, I'd already mentioned the 100 that you've got coming back in from recovery of the net operating capital. So you end up with a negative 30 in year 4, but then you add the positive 30 for the after-tax salvage value plus the 100, and you end up back at 100. And then once you bring all those numbers down, you've got the cash flows for the company. And you can then calculate your net present value the same way we would have done it before. So it's done 2 ways. In here it shows you with both the accelerated depreciation used and then also recomputed with the straight line depreciation. And also then the internal rate of return, the MIRR, and the payback in both cases. And the weighted average cost of capital is used is 10%. Now, one thing I'll note for you is this can get a little bit more complex if you haven't written off your entire project. So let's say that we sold it for $50, but it still had $20 values on the book. Then we would have subtracted that so that your gain would have only been $30, and then you would have only been taxed on that. So this is possible that you'll end up with a tax credit even if you have a lot of book value left that you're losing. So this can go in either direction.